Welcome to This Explainer. Today, we're looking at one of the absolute most fascinating situations in the market right now. We're investigating a massive, globally recognized juggernaut. I'm talking about a company with an ironclad brand, a brilliant management team, and a competitive moat that is practically unbreachable. Honestly, by almost every qualitative measure, it's an investor's dream. But there is a huge catch. When you sit down and run the actual math, this dream company might actually be a terrible investment today. We're, of course, talking about John Deere. Okay, let's dive right into this. The central mystery we're investigating today is a glaring disconnect. You have a genuinely world-class business, but a stock that the hard data suggests is overvalued by a whopping 31%. I mean, how can a company be so incredibly good at what it does, yet trigger a definitive do-not-buy verdict from value investors? Well, that's exactly what we're going to figure out together. So, here's our roadmap for today. 1. The John Deere empire. 2. Their technological moat. 3. Surviving the agricultural cycle. 4. Price versus value. 5. Our final verdict. And finally, 6. You get to decide which stock is next. Starting with Section 1, the John Deere empire and their business model, let's dissect how this 190-year-old agricultural giant actually generates its cash. Now, while those massive green tractors are the iconic image everyone pictures, Deere's revenue is actually split across 4 very distinct segments. You've got production and precision agriculture. That's the really big stuff like combines. Then there's small agriculture and turf, covering utility tractors and golf course maintenance. They also run a massive construction and forestry segment. But the fourth piece of the pie is actually the most misunderstood, and that's their financial services. If you just casually glance at John Deere's balance sheet, you might literally have a heart attack, seeing $84.4 billion in total liabilities. But you kind of have to view Deere as 2 totally separate companies. The equipment manufacturing side, that only holds about $5 to $6 billion in long-term debt, which is highly manageable. The other $65 billion in debt belongs entirely to their captive finance arm, and it's safely matched right up against $65 billion in income-producing receivables. Basically, they're operating a massive internal bank to lend money to farmers who are buying their equipment. Moving on to Section 2, a why technological moat and their competitive advantages. Let's look at why investors love this business so much. Deere's moat is layered, and it's incredibly deep. First off, you have a brand with nearly 190 years of heritage that's just trusted implicitly in farming communities. Then, you've got their traditional physical moat, over 1,900 independent dealers in North America alone. Think about it. If a combine breaks down during the harvest, a farmer needs a replacement part today, not next week. Every single hour is literally costing them money. Deere's network guarantees rapid parts and service that competitors like CNH Industrial or AGCO just really struggle to match. And that creates massive switching costs. Once a farmer builds a whole fleet of green equipment, it becomes incredibly painful to switch brands. But here's the real game changer. Deere is no longer just a hardware manufacturer. They're actively transforming into a high-margin software business. Their precision agriculture platform connects machines, accumulates vast amounts of agronomic data, and uses AI to optimize farming efficiency. And as more farmers use it, the AI just gets smarter and smarter, creating this incredibly sticky network effect. They are essentially building a digital moat right on top of their physical one. Section 3. Surviving the agricultural cycle. Because even the deepest moats can't control the weather or the broader economy. You see, farming has seasons, and so does the agricultural equipment business. Their revenue tracks strictly with highly volatile commodity prices and farm incomes. Just look at this dramatic earnings compression. Back at their fiscal year 2023 peak, Deere reported an unbelievable $34.63 in earnings per share. But fast forward to the projected fiscal year 2025 trough, EPS falls all the way down to around $18.50. That is a brutal 47% drop in earnings in just 2 years. We are very much in the deep winter of the agricultural cycle right now. So despite these plummeting earnings, the stock price hasn't actually cratered to match. You might be wondering, why on earth not? Well, it's because the market is currently paying what we call a cyclical premium. Investors are trying to look right past this current winter, anticipating a sharp earnings recovery when the cycle eventually turns. And because earnings have dropped, but the stock price has stayed stubbornly high, Deere's trailing price-to-earnings ratio is currently sitting at a really inflated 33.2 times earnings, which perfectly sets up Section 4, price versus intrinsic value. We understand the business perfectly now, so let's run the hard numbers and see what the stock is actually worth today. Here is the crucial point. As of this explainer, the stock is trading at a super lofty $589 per share. The market is clearly pricing in a massive amount of optimism and a very, very rapid return to those peak cycle earnings. But here comes the sticker shock. When you calculate the true intrinsic value, blending future cash flows with historical earnings multiples based on a normalized $22 per share, the true value sits at just $449. That reveals a stark 31% overvaluation. At $589, you are absolutely paying for perfection in a deeply imperfect cycle. Let's map out exactly how this looks across a few different scenarios so you can see the math. In a bear scenario where this downturn really drags on, the intrinsic value plummets to $270. Our base scenario, assuming a normal recovery, gives us that $425 to $449 range we just talked about. But look at the bull scenario. Even if precision agriculture scales brilliantly, normalized EPS rockets up to $28, and the market rewards them with a rich 22 times multiple, that highly optimistic intrinsic value is still only $616. That means at the current price of $589, even in the absolute best-case scenario, you're left with virtually zero margin of safety. And for the long-term compounders out there, the math is even more punishing. If you target a standard 9% annualized return over, say, a 16-year holding period, and you assume the base case exit value, the maximum price you could pay today to mathematically hit that yield is just $113. Now, are you ever going to see Deere trade that low again? Probably not, but it highlights a massive red flag. Future returns are already being heavily front-loaded into today's bloated share price. Section 5, the final verdict. Buy, hold, or sell. It is time to summarize our findings and render a final investment decision on John Deere. I think it's highly appropriate to channel the late great value investor Charlie Munger right here. Munger would absolutely love John Deere's dealer network, their brand, and their incredibly disciplined management. But his cardinal rule was to never overpay, even for a wonderful business. He'd likely take one look at a 33 times multiple during a down cycle, shake his head, and just walk away. And objectively, our SWOT analysis completely backs this up. The strengths are immense. CEO John C. May is a phenomenal capital allocator. He delivers consistent buybacks and maintains really high returns on equity. But we just cannot ignore the weaknesses. Extreme cyclicality that routinely chops their earnings right in half, combined with a current price that offers a deeply negative margin of safety. So our snapshot verdict on John Deere is a firm do not buy at the current price of $589. Look, if you already own it, the underlying business is absolutely strong enough to hold on to. But if you're a new buyer, you need to exercise some patience here. Wait for the hype to cool off, let the reality of this agricultural winter settle in, and look for an entry point back within that realistic intrinsic value range of $360 to $425. Finally, Section 6, which stock is next? You decide. We've thoroughly unpacked the paradox of John Deere, and now I'm turning the spotlight over to you. So I'm curious, will John Deere's new digital moat finally help them conquer the brittle agricultural cycle, or are they forever destined to be a prisoner of the harvest? Let me know what you think about that. And more importantly, what company's financial mystery should we dive into next? Do you want us to look at another industrial giant, a high-flying tech stock, or maybe a hidden value gem? Leave your pick below. Thank you so much for joining me on this explainer. And remember, never overpay for a wonderful business. Catch you next time.